It's all one big lie, 6 words. That's all it took to collapse the biggest financial fraud in human history. $65 billion gone. Thousands of families destroyed. Decades of trust vaporized overnight. And the most terrifying part? This wasn't some shadowy criminal mastermind hiding in a basement. This was the chairman of NASDAQ, a man your financial advisor admired, a man your bank trusted, a man regulators protected without even knowing it. So how does the most respected man on Wall Street become its most wanted criminal? Sit down, because this story will permanently change how you think about money, trust, and the people who manage both. Before Bernie Madoff became a synonym for betrayal, he was something far more dangerous. He was credible. In the early 1960s, a 22-year-old Bernie started Bernard L. Madoff Investment Securities with just $5,000. Money he saved from lifeguarding and installing sprinkler systems. Not exactly Wall Street royalty. Not yet, but Bernie was sharp. Relentlessly sharp. While traditional brokers were still scribbling orders on paper, Madoff was building one of the first electronic trading systems in history. Technology that would eventually evolve into the NASDAQ we know today. He didn't just participate in the market, he helped build it. He was elected chairman of NASDAQ 3 separate times. He sat on regulatory boards. He lunched with senators. He was the guy other finance guys called when they needed advice. Here's a fact most people don't know. Madoff's legitimate brokerage arm was genuinely one of the best on Wall Street. At its peak, it handled up to 5% of all trading volume on the New York Stock Exchange. That's not a fraud front. That's a real, operating, respected business, which is exactly what made the lie so perfect. While his 18th floor offices buzzed with real traders doing real work, one floor below, the 17th floor, was something else entirely. No windows, restricted access, a handful of loyal employees, and computers printing out trades that never happened. Business in the front, Ponzi in the back. So how did the actual scam work? Strip away the suits and the jargon, and it's almost embarrassingly simple. Investors gave Madoff money. Madoff promised 10 to 12% returns every single year. Bull market, bear market, recession, boom, didn't matter. Bernie's fund went up, always. The strategy he claimed to use? Split strike conversion? Sounds sophisticated. Sounds like something you'd need an MIT degree to understand. It was basically financial gibberish. Complex enough to sound real, vague enough that nobody could replicate it. A magic trick where the real trick is making you feel too dumb to ask how it works. The reality? He wasn't investing a single dollar. New investor money paid old investor withdrawals. That's it. The oldest financial scam in existence, dressed in a Savile Row suit and given a corner office on Wall Street. But here's what separated Madoff from every other Ponzi scheme in history, and the performance. Every month, clients received statements. Beautiful, detailed statements. Stocks bought at exactly the right time. Dividends collected, gains locked in. The paperwork looked perfect because it was entirely fictional, generated by an ancient IBM AS400 mainframe running custom software designed purely to produce convincing lies. And the feeder funds, hedge funds, and investment firms that funneled billions into Madoff's operation asked almost no questions. Some were true believers, others didn't want to know. Either way, they collected massive fees for doing essentially nothing except directing money into a black hole. Here's a jaw-dropping fact. Fairfield Greenwich Group, one of Madoff's biggest feeders, collected over $500 million in fees while delivering their clients' money directly to a fraud. In 1999, 9 years before the collapse, a financial analyst named Harry Markopoulos sat down with a calculator and Madoff's performance numbers. Within 4 hours, he knew. The math doesn't work. It's impossible. He's either front-running or running a Ponzi scheme. Markopoulos filed detailed complaints with the SEC 5 separate times between 2000 and 2008. He handed them a 17-page document titled, "The World's Largest Hedge Fund is a Fraud." He gave them the math. He gave them the logic. He practically gift-wrapped the evidence the SEC investigated. They asked Madoff for records. He handed them fakes. They said thank you and left. Why did they miss it? Partly incompetence. Partly intimidation. Madoff was powerful, connected, and deeply respected in regulatory circles. And partly something more human. We struggle to believe that the most trusted person in the room could be the most dangerous one. That blind spot, it cost thousands of people everything. The global economy detonated. Lehman Brothers collapsed, markets crashed 40%. Panic spread like wildfire. And suddenly, Madoff's investors, who had been perfectly happy not asking questions, wanted their money back, all at once. Madoff faced $7 billion in withdrawal requests. He had approximately $200 to $300 million in actual cash. The machine that had run flawlessly for decades, possibly as far back as the early 1970s, nearly 40 years, simply ran out of fuel. On December 10, 2008, Bernie called his sons, Mark and Andrew, into his apartment. They were senior executives at the firm. They knew nothing of the fraud. He told them everything. It's all one big lie. They walked out, called a lawyer. And the next morning, December 11, 2008, they called the FBI. When agents arrived, Madoff met them at the door. No bodyguards, no lawyers, no denial. There is no innocent explanation, he said. Just like that, 40 years of fiction ended in a single morning. The numbers are staggering. The human cost is worse. $17.5 billion in actual cash lost. $65 billion in fake paper wealth erased. Thousands of victims across 136 countries. Charities wiped out overnight, including Elie Wiesel's Holocaust Survivor Foundation. Retirees who lost everything, too old to start over. One victim, businessman Thierry de la Ville Houchet, was so devastated by his losses and those of his clients that he took his own life in his New York office 2 weeks after the arrest. This wasn't just financial fraud. It was a human catastrophe. In June 2009, Madoff stood in court and pled guilty to 11 federal felonies. The sentence, 150 years in prison. The judge called it a staggering crime. Madoff reportedly agreed. The SEC was dismantled and rebuilt. Whistleblower protections were massively strengthened. The Dodd-Frank Act overhauled financial regulation. Harry Markopolos became a hero and the uncomfortable symbol of a system that failed to listen. Bernie Madoff died in federal prison on April 14, 2021. Age 82, kidney failure. No memorial, no forgiveness. Just a closing parenthesis on the longest con in Wall Street history. Here's what the textbooks miss about the Madoff story. The victims weren't stupid. They were doctors, lawyers, Nobel laureates, sophisticated institutions. They were fooled not because they were naive, but because Madoff weaponized the one thing none of us can fully protect against: trust in a person who has earned it. The lesson isn't don't invest. The lesson is this: consistency that defies reality is a red flag, not a green one. If someone promises you returns that never dip, never lose, never fail, that's not skill. That's a story, and eventually every story ends. The next time someone offers you the world with zero risk, remember the man who already sold it to 37,000 people, one perfectly printed statement at a time. If this video made you think differently about how money, trust, and power actually work, that's exactly why we make these. Hit like if Madoff's story genuinely shocked you. Subscribe, because next week we're covering a con so sophisticated it fooled entire governments. And it's happening right now. And drop a comment. Did you think the SEC failed, or was Madoff simply too big to catch? We read every single one. See you next week. Stay skeptical.